My name's John Bartlett. I'm from Energetics. We're a end-to-end consulting firm specialising in policy, energy accounting and data management, efficiency and carbon reduction strategies, and energy markets and procurement, which is the area I sit. Today I'm here to, actually it's going to be a different sort of taste, I suppose, to what we've just had. And I'll be looking at the changing role of gas in the NEM and how we've seen that impact our large corporate customers in terms of, I suppose, gas alone, but we've also seen the relationship of the gas costs rising and how that correlates with the electricity prices we've seen shift in recent years. When we look back, I suppose going back to the last 10 years, the market's had the benefit of significant amount of ramp gas as they built the trains for the LNG export, the race to Gladstone as it was called, and that saw a lot of businesses achieve low gas costs by comparison to today's prices. It also saw over a 15-year period the introduction of more gas-fired power stations, OCGT, CCGT, and with that they were able to dispatch into the market with affordable gas prices. The comment up the top there we can see came from the Sydney Morning Herald back in 2014, where the market started the year in Brisbane at about $5 a gigajoule, and they were seeing it going down as low as 7 cents. And the article pointed out, I suppose, as the papers do, these businesses are going to have to flare their gas. Now that, to me, sounded a bit extreme, but in principle what they were saying was that supply is so high, how are we going to manage this in the short term? And the times have changed significantly as we saw that cheap gas, which was being contracted for $3 to $4 a gigajoule due to the oversupply, and the significant change at step 3 there where those LNG exports commenced in late 2016. As a result of that, we can certainly see that the exporters have created a rising demand on Australian gas, and in being short on their export targets, they've been buying from domestic customers as well, and that's put pressure on the domestic market. It also therefore leads to a point whereby the gas generators will weigh up where the value is of that gas that they've contracted. If they've contracted at a cheaper rate, they could generate it into the electricity market, potentially not oversupplying the market, but contributing to a suppression of prices. But if the overseas market or the LNG market is more lucrative, then there's a better channel or better way to get a return on that gas as well. This graph here looks back to 2011 at the average daily gas spot price in Victoria. Now I know that they have the 4 windows, but we've volume weighted averaged out those prices at a daily level. And in the orange portion of the chart, we've looked at what the average electricity spot price was for that year on the secondary axis here. Now, as a very basic rule of thumb, accounting for different types of generators and heat rates and how they're performing, if we apply a very simplistic rule of if you buy $4 gas, you're going to be wanting about $40 a megawatt hour to get a return on that. We can see the relationship between the cheap gas going back to 2011, where the spot price at about $40 was consistent when gas was more affordable. Now, there were definitely other fundamental changes in the electricity market over this time with reduced reliability of some coal-fired plant, closure of some coal-fired plant, but still in considering the closure of that those coal-fired power stations, that created a gap in the market which needs to be filled by the next available plant type. And that's where gas demand, or gas generation demand, has increased. Also to fill the gap between where the renewables were unable to meet that demand. And we see that as of, since the exports commenced, the spot price for gas increased to about, where are we looking there? Around about $10 a gigajoule. As we can see that line, the blue sort of lifting up there. And as a result, we're seeing electricity prices move closer to the $100 a gigajoule. So around $9, $10 a gigajoule on the spot price has been reasonably consistent with about $90 to $100 a megawatt hour in the electricity market. Now that makes sense if you're putting your gas nominations in for the next day and the electricity trading managers saying, all right, I want you to get X return on our generation, and then the gas contracts manager jumps over and goes, yeah, but what price are you valuing that gas at? So that's where you end up with a bit of a trade-off. You say, well, do we really want to be generating that gas and for a price of $80, $90 a megawatt hour? Or do we want to sell it to the spot market for $10 a gigajoule? Further to that, the spot traders on the electricity market will be weighing up, if I do dispatch that gas-fired generator, when I look at my whole portfolio, the coal-fired assets and the wind assets and whatever else I have, how much am I suppressing price on my total portfolio? Am I better actually leaving the gas unit out of there and getting a better overall return across my portfolio of assets? So this is where the relationship between, I suppose, from a trading perspective, what do I do with my gas? Do I sell it to the spot? Do I contract it longer term? Or do I run it through the turbines, where I want to be getting about $90 to $100? So when we look at how the market's shifted now, something that we saw last year, and it started, or was spoken about more after we had the energy crisis in South Australia. Energy experts like, what's his name, Wally Daly off the project would go in and they'd be criticising the minister, why didn't you turn on that Pelican Point? You had the ability to do so. Pelican Point had been mothballed for some time. It's not as easy as picking up the phone, putting the keys in the ignition and starting it. If they don't have a gas contract, if they sold all that gas, because the gas market is providing a better return on investment on that gas than the generator, then that's what a commercial entity will do. As far as when we looked at last June, or the June before last, the Queensland government came out and said, all right, we're going to direct Stanwell Corp to bring back Swanbank E early from its temporary storage, and we want them to be generating in Q1 of 2018. So therefore they've said, first of all, we're going to increase supply, not on a decision made by the business, a commercial decision, a political decision. Coming out to an election with pressure from market participants who had been buying from the spot, taking the risk because they didn't want to contract with generators or retailers for what they felt was a high price. They got burned on the market. So the Premier steps in and says, I'm making the decision about what plant comes on. In addition to that, she also ordered Stanwell and other government-owned corporations in Queensland to modify their bidding behaviour. And without going into too much detail about the bidding behaviour, was essentially saying, be less aggressive with your pricing strategies and don't try and make as much money as you can, which essentially is the game, if we could refer it to that. So that sort of government intervention is something that we're seeing more of now. Oh, and the other good example is the Malcolm Turnbull and the ADGSM, the Australian Domestic Gas Security Mechanism, whereby there's obviously the sovereign risk of governments intervening in the local market and trying to divert LNG gas back into the domestic market. But I suppose the mere threat itself, without having to invoke the ADGSM, has been enough just to keep things on track for now. But it will be interesting to see what happens with federal policy coming up. So forecasting political market intervention, I did have is nearly impossible, but then I thought Millerad might jump out and say, no, Plexos can do that. So I changed it to it's challenging. We can try and test the price sensitivities by saying, of course, well, you could have always looked at what a plus minus 500 would be in Q1. But being able to, I suppose, then try and further predict, when they say we're also going to tell them to modify their bidding behaviour and not look for the most commercially viable outcome for the business, that's where the forecasting becomes a little more political than numerical. Competition has certainly tightened. After if I can go, actually I won't go backwards. When we looked at, since LNG exports, the large market, or the large C&I market, has reduced down to, on the East Coast, has reduced to pretty much 2 retailers contracting with business. For a while there, it got down to 1. And with a vertically integrated gas provider being the only one in the market, as advisors to business, we were quite angry and annoyed that they were putting out offers with extremely high prices. So we're talking about people coming off 3-year contracts in the $5 to $7 world, or maybe lower, but then turning up with a $19 a gigajoule contract. And only months before, it was bad when they were offered at 10. The market's now back to around about 10 to 12 for large customers, depending on their consumption profile. But it was really it really highlighted the level of the gas crisis when people were being forced to sign up to $19 a gigajoule gas because there was no one else in the market. And very little was being done about it. I know that they had cups of tea in Canberra and they pointed the finger at the retailers saying, you've got to be better. They were really focusing very much on the domestic level, but at a large C&I level, it was being ignored. And as we saw in that last chart, while it's not purely mathematical, as a rule of thumb, we're seeing the gas units now, most likely, and with the withdrawal of more coal-fired plant, the gas units will be the marginal unit. Now, while they might set, when I say set price, they may rebid that obviously to a stable load, but as the marginal unit, that's where we're seeing the level of coal being, or the coal generation being met, and then moving on to gas-fired power generation. And with that, we will see that being reflected in the gas costs going forward. So the challenges looking forward. Gas generators are largely non-government, with exception to that Swanee example, but that's probably why I've made this point in mentioning that they're non-government, is that an organisation that's primary responsibility is to return to its shareholders will be incentivised to maximise its profit and perform commercially, unlike the political generation of a Swan Bank, for example. You've probably heard of the duck curve effect with the rapid expansion of on-site solar. This, I believe, creates a big problem for gas-fired generators in how they operate. If, for example, the highest cost to a gas-fired generator are in start-up and shutdown, where they use the most effective operating hours, and then if we believe that the prices will stay around $10 a gigajoule for gas as an opportunity cost, then we want to be seeing sustained prices at about $100 a megawatt hour for those gas-fired generators to stay online. If we end up in a world where the value of running that generator is in the morning and evening peak, for example, we will have what's referred to as double shifting of that generator, and therefore they will have higher incurred costs in starting and shutting down in the morning and again in the afternoon, which then may increase the value as to which they're willing to dispatch that generation above what we believe the fuel cost to be. So for a gas-fired unit to perhaps start up, run for 2 days and then cycle, shut down, then put on the second unit and maybe rotate those over, now we're looking at, will they want to dispatch for just a few hours and then to do so in the evening? The relationship with the high gas prices and high electricity prices, as I've just said, we need them to have that incentive from the electricity market to get the return from the gas market. I'm going to be moving on to 5-minute settlement in a minute, but that touches on in a 5-minute market as well as in a duck curve day shape as well. And here I mentioned here the 2-shift operation of a plant. It's a more expensive and less efficient way of operating. This is my last slide, and following this I'd like to hear your views. If you've come from a 5-minute market, for example, overseas, be keen to hear what you do, or just your opinions into how things may look. Certainly, Nick, if you have any views in your ESU or assumptions, that would be good. I'm not saying I'm for or against the 5-minute market. I think the market customers who put forward this rule change proposal have done so with the intention of moving to lower wholesale costs, and in doing so they believe it will reduce the ability for generators to game the system. And that's the current method is to have your 6 5-minute dispatch intervals, and your average generation over those 6 dispatch intervals and the average price over those 6 dispatch intervals are averaged out. What the gaming idea refers to is that you could generate high for 4 of those intervals and, let's just say, close off, and the proportional sensitivity of price will give you a higher return by generating less in that half-hour period. That's probably the negative view of that market. The positive view of a 30-minute settlement period is that if there's a high price in the period, it gives the generators time to react. A gas generator is likely to make an informed decision to start up in order to capture some of that revenue, and therefore you'll see a suppression on price. If we see a $14,000 price, it's not uncommon to then see it followed in, shortly after by a negative price, and then end up with an average of maybe $1,000 in a half hour or something like that. But at least it shows that the market is working if, under a high price scenario, other generators are coming in and therefore suppressing price. So moving to the 5-minute market, what's going to happen if you have a price spike and you've missed the boat, 5 minutes? Are you going to generate if the short-term parser is still looking somewhat mild? Or if the current 5-minute or day ahead is still looking quite mild? Are you going to generate at risk of other plant ramping up and also generating? And once you've started up, has the price now gone to negative 1,000 and everyone's online? In which case, there's no reward. So therefore, do you decide to start up in the morning, run through the day in the hope of capturing a calculated result? Or do you say, no, I'm putting my gas unit in storage and I'm just going to be taking my chance of a higher pool price and getting a higher return on my coal-fired assets? So that, I suppose, is the dilemma that I think the 5-minute settlement puts on us for mid-2021, is how will generators behave? In particular, how will gas generators behave? How will they get return on the cost of gas if the shortfall or the scarcity, however we wish to put the current state of the market, remains going into the next 5 years? And how will that be managed? Does anyone have any views?